to mitigate bad luck in investments and how they can implement that into how the investors can implement that into their personal investments.
With asset allocation, it's how do you do that is it's through diversification. Diversify. That means owning other types of risk assets and non-risk assets. So whether that means more cash or bonds, treasury bills. It's not just owning one stock or stocks within one market, but owning stocks from across the world, right?
Think about using social networks and other information from the internet when starting investments.
I think it can be incredibly misleading for a host of ways. I think the thing to keep in mind is you don't know someone else's financial situation. Keep in mind is just like what matters to you and what are the things that you should care about, and trying to keep an absolute measure of that.
So let's move on to some investment strategies part, maybe, the risk management.
Yeah.
And I loved all the methods, the three methods that you mentioned about mitigating bad luck on investments. I think here in Japan, a lot of people were scared about investments because it's the volatility of the Japanese stock market had been very high over the past 30 years, looking at at some parts of the stock market. So can you quickly run through the three methods to mitigate bad luck in investments and how they can implement that into how the investors can implement that into their personal investments?
Yes. So I'll address all that. So I would say there's three different categories, and I'll talk about the categories and then talk about how you actually apply it, right? So the first category is what I would call asset allocation, which basically just means what do you own? Like, do you own only Japanese stocks? That could be an asset allocation. You could only own US stocks. That's a different asset allocation, right? So what do you own? That's the first one. I'll get into that in a second. The second one is what I would call income diversification of some sort, which means like how are you earning money and how is that changing over time? And the third one is what I would call like spending diversification. So how are you spending money? So how do you mitigate bad luck in each one of these? So with asset allocation, how do you do that is it's through diversification. It's not just owning one stock or stocks within one market, but owning stocks from across the world, right? And so I agree, if you had been a Japanese investor in the late 1980s and you put all of your money into Japanese stocks in the late 80s and you didn't do anything else, yes, you would have had a very rough 30 years, probably one of the worst in history, right? But how many people are doing that? It's putting all their money in at once. That's one of the issues. Two, just into one asset class and specifically one market. Those two things alone are very rare. Most people buy over time, right? You're getting money, you're buying a little bit of point. And I talk in the book, like if you had bought over time, the story is very different. It's still not great, but it at least kept pace with inflation for the most part, which I think is one of those things where we're talking about when people talk about at least the Japanese stock market, over the last but until very recently, for 3 decades, it was considered one of the worst stock markets in the world. It had one of the worst equity performances. And I think one of the reasons for that is because, you're cherry picking. You're picking the highest point and you're saying, look, from here to here, it did very badly. And like, yes, if you do that, but someone who is buying over time would have had a very different experience. And I think we should keep that in mind because that's how most people invest. We're not buying once, or you shouldn't be just putting everything you have into the market at one point in time and never buying again. That's very rare, very unlikely. So how do you reduce bad luck? Diversify. That means owning other types of risk assets and non-risk assets. So whether that means more cash or bonds, treasury bills. I mean, in my case, it's U.S. treasury bills. For Japanese investors, it could be some sort of Japanese bond. I tend to own what I call shorter duration fixed income or bond investments. So I don't want anything that's going to mature over 5 years from now. I think because interest rates fluctuate too much, it's a little too risky. And we saw what happened, at least in the U.S. in 2022, when interest rates just shot up a lot. And as a result of that, a lot of these bond prices just tanked. So we saw they went down. The United States 60-40 portfolio had its worst year going back to, I think, the 80s or 70s, just a really bad year. So as I said, think about the diversification element on your assets. In terms of your income, like what can you do when you're having bad luck in investments? Is there something else you can do to earn more money to offset that, right? And I think specifically about retirees, like if you're retired, you're like, I don't need to work. Well, if you go through a bad period with your investments, maybe you can pick up part-time work to offset those losses. That's another thing. And then the third thing, as I was talking about spending, what can you do to spend less money? So in a given, let's say, once again, if you're retired, maybe in a downturn, you kind of cut back your spending just a little bit. And then in a good year, you can kind of crank it back up, right? You can increase your spending again. So it's just thinking about what are the levers you can pull. You have a lot of options. I think a lot of people, when they worry about bad luck, they think, oh, there's nothing I can do. And that's almost never true. You almost always have options. And so the question is, what option are you going to use? Are you going to use asset allocation? Are you going to use your income? Are you going to use how you do your spending, whatever? And so thinking about those and which lever you want to pull, as I say, that's kind of the main takeaway in this instance.
So as for the asset allocation, you mentioned the treasury bills and the bonds. So they work not just as an income asset, but also as like a, what can I say, like the bubble wraps in your portfolio, right? So it's more like a cushion in your portfolio, I'd say. Because I mentioned that simply because right now, for the Japanese investors, especially in the younger generations, they do monthly savings using the all-country index, ACWI, MSCI ACWI, or S&P 500 index funds. So their risk is solely on the U.S. stock market instead of the Japanese market. So, and another point of that is that they also have the currency risk. They have to think about the currency risks when investing from Japan to the international country. So do you have any thoughts on the currency risks associated with the investments?
Yeah, so currency, it's tough because no one knows what's going to happen with the futures or currencies. The one analogy I heard, which was very interesting, and I kind of liked it a lot, there's a European investor. I was on a talk with some European investors, and he said something like, and he was talking about currency risk. He says, your house can't burn down twice. So let's say your currency is doing well with, let's say, the dollar, and then it gets devalued and it goes down.
Right.
Could it keep going down? Possibly, but usually these things tend to revert at some point. So you're not going to see, you had a bad thing happen, the currency got devalued, but it's unlikely to happen again, right? Like you can't go much lower. And of course, that's not guaranteed. Of course, currencies can keep losing value forever. It's very possible, but there's very few times, especially like a large developed economy like Japan, where that would happen. Like, yes, if you're hyperinflating your currency, like, we talk about Zimbabwe or Argentina, there's all these countries that have had these issues. I don't think the Bank of Japan is going to be like one of those examples. As a result, like, something bad happened, the yen was devalued, but like, it's probably not going to be devalued so much further where it's like, we're going to go through that again. So those risks exist in the short run and they're very real, but over long periods of time, like, that should revert in some way. And that's what I would expect, right? I would expect mean reversion in some form with currency risk. And things will change, policies will change, that'll affect that. And I'm not the expert on currencies. I will be the first person to say that. But that's what I think about. I try to think in the long run, those things wash out. It's unfortunate because we live in the short run. So we don't get to, like, we have to wait for those things to kind of correct. The only thing you can do is you could buy other currencies. If you're worried about that, like, okay, you can have a US dollar allocation. But once again, the US dollar is being devalued through inflation in the US market. So you can hold that as like a hedge, but that dollar is going down unless it's invested in like a US Treasury bill that would offset that. That's a whole nother discussion though. But I hope that kind of explains what I'm getting at here. So
thank you. And as for the investment, I have another question about the goal-based approach. I think that's the most ideal way. And that's also, I think, is a common sense that it's an ideal form of investment to set up a goal at the first point and do the goal-based approach. But I personally believe that setting a goal itself is quite difficult under current circumstances. So what are your thoughts on this point? And if you have any advice where people can look for an advisor, do you think that's most ideal way, or how can you set up a goal and all that? Do you have any advice on that?
Yeah, so let's do the goal setting question first before I'll get into the advisory question. So in terms of thinking about goals, like I think it's you don't have to have goals, but it's better to have something, or at least a vision of kind of where you want to go. You don't have to have a specific thing. Some people work really well with like, I need to have this thing by this date. Of course, things can get in the way. And so what I find generally is most people, at least with financial goals, they're either going to miss it or they're going to massively exceed it, right? It's very rare that you're like, oh yeah, I got my goal and I was right on. Like people either below or above, right? And so that's what's so interesting to me is about goals, right? And so in terms of financial goals, I think the main thing to take away here is that, it's better to have something to like look forward to than to have nothing. So I agree with you that it's tough to hit goals, and it can be tough, especially with, the future's uncertain. You can like, oh, I'm going to hit this goal, and if you lose your job or something, that completely changes the trajectory of that. So I agree that can be difficult. In terms of, advisory stuff, when should someone look for an advisor? I think it depends on the complexity of their financial life in particular. And I don't think there's a specific amount. We could talk amounts. I can say in the US, like in general, I don't necessarily think it makes a ton of sense to get a full-on financial advisor, full financial plan, the whole thing. For less than $1 million. Of course, there are people who are very young who are earning a lot. Maybe they less than $1 million US. They might need a little bit of help now, but they'll need a much more expanded relationship later. So that's in general. I mean, we do provide advice to people with less than $1 million, but it's not as comprehensive as a full-on financial advisor. Maybe you ask a couple questions a year. You might have one short meeting a year, things like that, but you won't need a full financial plan necessarily. So, and I think what would those amounts be in Japan? It might be like 100 million yen, which is like, that's equivalent to like almost $700,000 in USD. So when I think about that, that's the point where I'm like, yeah, you probably do need an advisor at that point, or at least start thinking about it. But once again, it comes back to the complexity. Where are you in your life? If you're young, you're just earning money, like you don't have a lot of complexity. You don't have maybe a spouse. You don't have, any sort of will or anything like that, then you probably don't need to worry about it as much. But if you're getting older, if there's more complexity, if you're starting to think about planning, family planning, legacy, all that stuff, that's where we, financial advisors in general can add more value. Last thing I want to say in that, I know the financial advisor space in Japan is very different than the US. In the US, what's called a registered investment advisor, RIAs are becoming more popular, and that's where I work. I'm talking my own book a little bit here. And so RIAs work by like helping you do planning, and they charge a flat fee, let's say 1% a year, hypothetically, right? That's how it works. I know in Japan, a lot of these relationships are through larger banks, through some of the mega banks, and some will just have an advisory fee, just like an AUM fee. Others will have commission-based products where you're paying it in the actual commission, or just through the return you're getting is a little bit lower. So just be mindful of what fees you're paying, I'd say. I don't think one is necessarily better than the other. I generally obviously have a preference for just like an AUM-based model, but you just have to know what fees you're paying. Right? That's what matters. Like I think commission-based can work if the fees are low enough, but generally they're not. They tend to be higher. So that's one of the things that can be a little, just look into it. That's why I say look into it, understand what you're paying. As long as you are okay with the fees you're paying and how you're paying those fees, they're always going to be there somehow. Just that's the thing I'd say is just know what you're doing. As long as you kind of, everyone's transparent about how it works, and if everyone's okay with it, I'm completely fine with any sort of fee arrangement. So
I see. Okay, thank you. Okay, so let's move on to some questions on the asset classes and portfolio construction.
Yes.
You mentioned a little bit about the Japanese stock market over the past 30 years. How about for the Japanese stock market? Do you think it would be better to invest in individual stocks or maybe active funds, actively managed funds, instead of maybe investing broadly through ETFs or index funds? What do you feel about those markets that were not good enough to, invest overall investment that didn't work that much in Japan? Do you have any thoughts on the individual stock investments?
Yeah, so
those types of markets?
Yeah. So apologies. So in general, I would say in the U.S. with U.S. stocks, like it's very clear that active managers in, let's say, the U.S. large cap, U.S. large stock space have not outperformed the index over a long period of time. Exactly. And so as a result, passive indexing has taken off. It's, probably the biggest, change in how people invest in the United States over the last, let's say, 20 years at least. I know in other markets, it's a little bit easier to, quote, beat the market, but still it's difficult, but it's slightly easier. So I would say in general, I'm a fan of just buying the whole market, you know, buying a passive
It's very
overall.
simple.
Yeah. It's simple. It's easier.
Right.
And there's no, I think the issue isn't even whether the active manager can beat the market, because some of them obviously can. I believe there's skill there. I believe it's easier in markets that are less liquid or more overlooked. Everyone's looking at, in the United States, everyone's looking at Tesla, Apple, Nvidia. People are already looking at these stocks.
Right.
If you have a play there, it's very tough to know what that is, and it's very difficult to outperform. It can be difficult. Obviously, those stocks all have outperformed for the record, so I picked the ones that did. But in general, it's difficult to do this type of stuff, right? So, but in other markets, you know, it's possible to outperform. I just think personally, from my perspective, I don't like spend the time on it, the effort. I think my efforts are better focused on my career and those types of things. I'm going to earn more money off that than trying to go and beat the market by an extra 1% a year. So instead of saying, okay, I could buy Japanese stocks, a passive index fund that owns all the Japanese stocks, I would rather do that and not spend more time trying to vet managers or pick particular Japanese stocks. So for me, I think that's the approach that I recommend for most people. It's nothing against the active managers. I think what they do is very valuable for the market, and obviously some of them can outperform. But I think the issue is, from my perspective as a retail investor, is like, where are you spending your time? And so if you're not buying the overall Japanese market, you have to either be doing research to pick stocks, or you have to find someone else who you think is good enough. And so there's a time element there, a time cost that I think is better spent elsewhere. And if you're just trying to maximize dollars, like maximize your financial success, I think that's better spent on other things. So that's my take on the issue. And it's nothing against the active management industry, nothing against any of those. It's just like a time thing. Like I'm trying to help you as an individual. I think that's where you would spend your time.
So that's why you said that you carbon copy your portfolio for your 401k and the other accounts as well. Right?
Yeah. So most of my accounts, they're kind of the tickers change slightly, but basically they're all like similar. They're all like
the same.
Yeah, basically. So yeah. So my what's called an IRA and like the NISA of the US, the IRA, those positions, the rough percentage breakdown, the asset allocation, so to speak, in that portfolio is roughly the same as what's in my 401k, as what's in my brokerage account, right? The only difference in my brokerage, I will have like treasury bills or something if I'm trying to buy a house or something. So outside of that specific money, everything else is roughly the same, and they're all copies of each other. And it just makes it easy for me because I don't spend a lot of time on it. I really don't spend a ton of time managing my financial life because I've already set all those systems up, and I'm spending all my time trying to create content, doing other things to try and help other people. Because I think that's more valuable for me than trying to beat the market by 1%, 2% a year. I don't think it's going to be worth as much. Maybe when I'm 60 or 70 years old and I have a lot more capital, let's hope, then yeah, that extra percent is a lot more. But for now, I don't have enough saved up where it's going to make as much of a difference as the work I could be doing, which is creating content and trying to help investors.
I see. So do you do a rebalance at the same time for all those portfolios, or? I
try to like once a year, and it depends. Every portfolio is different, right? So if you think about in the case like of the IRA, which is like the NISA, I'm not putting more money in there. Those are basically the amount in there is fixed, and it's only going to change based on market values and growth. So I'm not adding money, right? So I will rebalance those probably once a year. Now, in my brokerage account or my 401k, money is consistently going in there, right? So as a result, what I like to do, and I talked about this in Just Keep Buying, is called an accumulation rebalance, which basically means instead of selling one thing and buying more of another, I just buy the underweight thing. So if I don't have enough bonds, I just put all that new money into the bonds to bring the bonds back up, right? So that's kind of how I keep things in balance. So I'm always kind of rebalancing throughout the year just by consistently buying all the underweight stuff. And then in the accounts where I can't add money because for a host of reasons, I will just rebalance those once a year. And how often you rebalance doesn't matter all that much. I mean, do it at least once a year, I think matters. That's easier for tax reasons, at least in the US. But you know, there's no frequency. We've looked at this. It's been studied so much. Once a year, once every other year. It doesn't. Every quarter, it doesn't move the needle enough. It doesn't matter. So I don't waste time. I spent too much time on this already in my life. So I don't want to spend any more discussing rebalancing because it's just like I haven't found. There's no winner. There's never a winner. And in one period, and if you look at the data, it's like, oh, this you should have done once a year. And then another period, it's like, oh, you should have done once a quarter. And it's hard to know ahead of time. So I don't waste my time thinking
Okay,
about
so
it. Yeah.
just maybe once a year.
Yeah,
is an
once a year is
ideal way.
perfect. It's
maybe
easier.
your birthday or
Yeah, exactly. So something like that, or just for tax purposes, most people do it
Right,
end of the year. I mean, for in the U.S., right, our January, December is our tax period. That's when we run it, and so I either rebalance in December or January. Most of the time it's December, but and I just pick a different day. It doesn't really matter, So
it doesn't have to be an exact date, but maybe
yeah,
somewhere in maybe end of year or your birthday or somewhere you can remember. Okay.
Exactly.
All right. Yeah, and about the rebalancing, you said that it's all about controlling risk. I think this is a very important point because when talking about rebalancing, everyone thinks that you are looking for more active investments, or if you want to, whether you want to look for additional returns. But yeah, it's about controlling risk. So I thought this was also a very important quote about rebalancing. And I want to move on some other points about the last portion of your book. What I liked was the quote called "I'm not rich, they are." That was very interesting, and I think under current circumstances where people gain information from social networks like Facebook, Instagrams, and so on. Everyone wants to know what other people are doing on their investment. What do you think about using social networks and other information from the internet when starting investments?
I think it can be incredibly misleading for a host of ways, because what you're seeing isn't necessarily representative of the underlying data. And so once again, I don't know all of the data on Japanese household wealth. I do know it for the US quite well because I've studied it, and there's a lot of really good data sets out there that the United States Federal Reserve releases. And so I think you have to understand it's good to have data on this, because if you don't, you can convince yourself you're always poor, like you're always relatively poor. I want to be very careful when I say that, relatively poor, right? So like, I think, and there was this great interview, and I talk about this in the book, with Lloyd Blankfein, who is the ex-CEO of Goldman Sachs. He's been there a long time. He's a billionaire. So he's one of the richest people on the planet, no debate, right? Very, very rich. But he was hanging out with people like Jeff Bezos of Amazon and David Geffen, who have 10, 15, 100 times his net worth. And so relative to him, these people, he's on a super yacht with someone. This yacht is, $300 million, $400 million. He can't, he could only buy one of those and that's it. Like, he can't afford that. So for him, from his perspective, he doesn't feel as rich as these other people he's hanging out with. So he can, quote, feel like, oh, I'm just like relatively well off, even though he's objectively like very, very wealthy. Right. And so I think that's the thing. And especially with social media, like, you don't know when someone posts something in social media, whether that thing is rented, whether they took out debt. You don't have their balance sheet. And I'm not saying you should have their balance sheet, but I'm just saying, like, people can give off an image of something that isn't reflective of their actual financial situation. And we see this happen all the time, where people try to, what we call flexing in the United States, trying to show off wealth in some way. And you end up finding out that they're either bankrupt or they're like right on the verge of having no money. And so I think the thing to keep in mind is you don't know someone else's financial situation, and you don't know how much of that is going on. And so the thing to keep in mind is just like, what matters to you, and what are the things that you should care about, and trying to keep an absolute measure of that. Like, that doesn't move. You don't want to be moving the goalposts, as they say, like always changing. Oh, once I get here, I'll be happy. And then you get there and you're like, oh, actually, once I get here, and you kind of keep increasing and you're always chasing, and you never really make it there. Right. So I think that's the thing to keep in mind when it comes to thinking about wealth and relative wealth, or your wealth relative to others, is like, what actually matters to you? Like, write that down. And then if you ever hit that goal, like, go back to it and say, like, how do I actually feel now that I've hit it? You probably aren't going to feel as good as you thought you would feel like back then. So just keep that in mind. Just remember, like, a lot of people, especially with social media, you're only seeing the outliers, especially in investing. You're going to hear about people who bought a cryptocurrency, and the cryptocurrency went up 10,000x. And so, I put in $100. Like, I know someone that spent $250, bought these Solana, that's a cryptocurrency. I'm not recommending that, by the way. I'm just saying, he bought a Solana like NFT, like an image of a monkey or something. And these things, it was at one point his portfolio was worth over $1 million USD, right? So it's like, I mean, he obviously didn't sell. He only ended up, by the time he sold and everything, he still got like $90,000 out, which is a lot of money to go from 250 to 90,000 is like, and then like, that's one of the greatest returns I've ever heard of, right? But that's the type of stuff where you'll hear about those people. And not everyone has someone like that, but I don't know a lot of people like that. And that's a very rare circumstance that is not normal. I also know people that, you know, put in a lot of money and then lost a ton as well. And you don't hear those stories as much because they're not as like fascinating. Like putting in $10,000 and then losing 5,000 is not as fascinating as someone who put in 250 and pulled out 90,000, right? So that also is a thing. It's like there's a lot of selection bias going on when you're looking at social media, and you're only going to see the most outlandish, craziest stories, whether they're real or not. And so just keep that in mind. It's just something that I try to be mindful of when I'm looking at this stuff. And also I think everyone should be, because a lot of people will mislead in some ways to show off a certain image. And so you got to be kind of careful with that. So
I see. Thank you. And the last quote that I really loved the most in your book was the quote, we begin our lives as growth stocks and end our lives as value stocks. Can you walk through this quote and give us some message for the Japanese investors, please?
Of course. So I know you're a research analyst, so I know you probably particularly like that quote. So the idea with the growth stock is growth stocks are usually growing very quickly, and as a result of that, like their valuations are bid up. And so investors are very optimistic about the future of those companies, right? They're growing quickly, they're seeing more sales, more profits, et cetera. And so what happens is, instead of waiting for those profits to come in, investors already kind of bid up the price to where, okay, as long as the sales come in at this amount, the profits come in at this amount, this is what I think the price should be. And then over time, as the earnings come in, if they beat the earnings, the price can be up or it can go down, depending on how people feel about that. So that's what a growth stock is. And I think a lot of people, there was some data that showed this, people when they're young, in their 20s, they're a lot like growth stocks. They're thinking about their future. They're imagining, oh, I'm going to be this and that, and they have all these ideas. And then they get older, and some of those things work out, but some don't. And that's true of everyone's life. There are certain parts of my life that are much better than I ever thought. And there are other parts where I was like, oh, I thought this would have happened, and it didn't happen in the way I thought it was going to happen, right? And that's more personal, and we don't have to get into that now. But all I'm saying is that's the growth stock idea. The value stock, those are the stocks that have kind of been beaten down by the market. People are like, oh, those stocks are junk, blah, blah, blah. But what happens with those stocks, at least historically, is those stocks will tend to outperform because people don't think much of them, that any positive surprise is a huge jump. And so you'll see their prices kind of come up. And so that's what's happened historically. In recent history, value stocks have not been doing well growth. It's all about growth stocks. So that's been the name of the game in the last, just decade, basically. Like value stocks are doing worse than ever. But I think in some ways, people as they age are kind of like value stocks. And you see happiness generally is people are happy in their 20s, 30s. There's like this kind of dip, and then it kind of comes back up. So it's almost like an inverted U or a smile, right? So it goes down into middle age, and then it kind of comes back up. And what happens is, I think, is like people set their expectations very high. Not everything in your life is going to meet those expectations. You start to, quote, get sadder. Your happiness comes down. But then you start to find all these other things in life that are like positive surprises that you maybe wouldn't expect. And for some people, it's like having a family. For some people, it's traveling. For some people, it could be all sorts of stuff, right? And so as those things start to occur in your life, you'll start to come up on the other side. And that's where the value stocks kind of come in. So your life starts as a growth stock and is very likely going to become a value stock. So it's not a bad thing. I think it's a good thing. And I think it goes to show that there's a lot more in life to value than just what your initial hopes and dreams were. And there's a lot of other things that you can be surprised by, things that you didn't think you would enjoy as much. And as you got older, you really appreciate it. So just something to keep in mind. I think people talk a lot about money, but there's a lot more to that than just money. And I try to, that's the hopefully the message of just keep buying in another way. But
I see. All right. The education. Can we say that the education itself is an investment? Because especially in Japan, because of the cultural and historical backgrounds, there's a tendency to view education as not as an investment, but more like a social welfare. So, but you mentioned in your book about the college tuition and everything. So, can we say that education is an investment?
I would say definitely. I think of education as an investment. Now, of course, whether you get a positive return on that investment depends on a host of things. One, what's happening in the overall economy, how the economy is doing, right? You could graduate from college, actually have skills, all this stuff, but if the economy is not doing well and no one's hiring, there's not much you can do for that particular thing. You might have to use your skills in a different way or kind of rethink how you would use your skills. So that's one thing. But in addition to that, like, I think it's an investment, as I said, like the best way to raise your income, I think for most young people, is to develop a skill. And so it's an investment in the sense of if you get the right skills or the skills for your particular economy. So I don't know, those skills are going to vary if you're in Japan versus if you're in the United States versus you're somewhere else, right? So think about what are those skills, and you'll know this because you'll either you'll have peers or friends kind of going into certain industries, or you can do research to figure out like which companies are hiring. So in the US, in the last 5-10 years, it's been software, right? Getting into software. Now we have, LLMs, AI that does a lot of that software and can do that for people. But I still think it's valuable to understand software, because if you can work with these things, if you can work with an AI like a ChatGPT or a Claude or something, and you can write software more quickly than other people, then that's still a skill. And that there still is value to knowing software and knowing those things, even though AI is making this much easier. So that's just an example of something like that. But I completely think it's an investment. It's just, what are you getting the skill in, and is there actually a market for that? That's the harder part. And it's difficult because when you're young, you don't exactly know what you want to do, and you don't know, you may not do research on is that area going to be hiring, but you have to think about, okay, what am I really doing my education for, and will I be able to get a job? Will I be able to kind of have a valuable skill that's going to help me so I can support my lifestyle? That's the big question. And it's difficult. It's difficult. It's not an easy thing. If this was easy, we would all just be, it wouldn't be a problem. But as you can see, some people go into debt and then they find it hard to have a job, and then they can't get out of debt. And so that's where it becomes problematic. So I say you just have to just be really mindful of like the choices you make when it comes to education and things of that nature. So that's what I would keep in mind. Yeah.
I see. So with that in mind, what should be discussed in the family from the teenage years, maybe in the high school or maybe in the middle school or high school?
Yeah, I would say try and figure out what you enjoy doing. And I think because the reason why focus on what you enjoy, because if you enjoy doing something, when you face a roadblock or you face a barrier that's preventing you from progressing, if you enjoy it, you are more likely to push through that, right? If you don't enjoy it, the first time you're like, oh, there's an obstacle, I'm not going to do it, I'm quitting, right? And so I think the key here is, do you enjoy it a lot? And if you enjoy it enough, you will be able to outlast other people who don't enjoy it enough. And as a result, you're more likely to succeed than them, all else equal, right? So I think that's the thing I like to think about when I'm thinking about skills and stuff like that. So like, I like financial markets. I like writing about them. I like doing that. And so that, I think that helps when, like, as I said, I didn't make money on this for 3 years. I think most people, if they didn't make money on it for 3 years, would have said, why am I doing this? It's a waste of time. But I just enjoyed it. And so that gives you an edge. And so that's something I like doing. There's other things I wouldn't like doing. For example, I talk about photography. I would not like to be a photographer. I don't think I would enjoy doing that. Even if you started paying me from the beginning, you could start paying me and I still probably wouldn't like doing it. Right. So that goes to show it's not just money. I think interest matters a lot more. So when you're talking to middle school or high schooler, it's like, what are the things you're interested in, and how does that kind of intersect with career? And so I think about that. And it's not always going to be super, as I said, it's not always easy to figure that out. Like, you're like, oh, I like video games. Well, unless you're like a professional someone who's a professional video game player in a competitive league, it's very unlikely you're going to make money. And even those people, it's difficult to make money to win tournaments, and there's a host of things you have to do to get there. But unless you're trying to get to that level, like, okay, what else do you like besides that? Like, what about the video game? Is it solving problems? And so as you go through that, you might find that there are other things in there that can be filled by a different role or a different industry. And so I would say, like, figure out what those things are, because that's going to be more valuable to you in terms of how you look through your career and what you think about get a degree in or get an education in.
Great. So you're still enjoying writing?
Yes, I am. Even after 8 years.
Great to hear that. Great to hear
you have to enjoy. You have to enjoy what you do. Otherwise, as I said, you're going to give up or you'll quit at some point. So, and I think that's the key. That's the same with education. You have to figure out, what is the thing I really like and care about, and because I want to stay in this. And of course, your interests will change, and that's fine. But at least try to figure out something, at least initially. Try it. If you don't like it, switch to something else, right? And that's the point, is to experiment, right? And that's where you're gonna get a lot of, you're gonna learn a lot from that.
Great. Can we have some message to your fans in Japan here?
Oh, yes.
And all the viewers of this video, please.
Oh, yes. Thank you. So just thank you for taking the time to watch this and read the book, and I truly appreciate it. I know it's so funny in the United States, there's this Japan is like the Japanese stock market. I don't want to say Japan is a country or the culture. I mean, the Japanese stock market is like the butt of a joke. There's like a joke that's like, oh, when I talk about how great it is to invest, everyone says now do Japan because the Japanese stock market hasn't done as well, right? And it was always like a kind of it's like a comeback or a way to like respond to someone in kind of a negative way. And I've always said like, I don't like thinking of things that way because as I show in the book, like if you had been buying over time, it's a very different story. Yes, it was difficult to be an equity investor, a pure equity investor in just Japanese stocks for a long time, but obviously things are changing. The market, the Nikkei is at new all-time highs, which is great. And so I just want to say, I appreciate you guys following along and I wish you all the best in your wealth building journey. So thank you. Arigatou gozaimasu.
Oh, thank you very much. Thank you, Nick, again for your time today.
Yes, thank you.
Thank you so much.
Of course, anytime.